So, Steve, we love to talk to you about investing. Get your thoughts. You have an awful lot of money you're responsible for putting to work. So give us your sense, particularly right now with higher interest rates for longer, something that you anticipated on Wall Street Week a couple of years ago. It's come to pass. How is that affecting your investment decisions?
Yeah, I think we do have higher interest rates for longer, and we have been cautious about the equity markets for some time. Obviously, that was not completely correct last year and the first few months of this year. But I'm never going to get it exactly right. I feel comfortable with being in a somewhat defensive posture. I think I've said on this program before, we pivoted a lot toward credit because the risk-reward ratio between credit and equities had really narrowed dramatically with interest rates going higher and giving us a lot of opportunity in credit. And that is still our position. The market has remained more resilient in the face of a rising 10-year for the first part of the year than I would have predicted. The last week or so, obviously this month even, the market is certainly taking into account the fact that the probability of Fed rate cuts, I think, is close to zero for the balance of the year. And so we're going to maintain a reasonably defensive position.
What are you anticipating the Fed's going to do?
I would take slight. Larry Summers didn't say exactly what he was. The headline said he said, but what I think he actually said was a 15 to 25% chance that the next move was up. And I'm going to take the other side of that bet. I think for the Fed to raise interest rates in this environment, election year, no election year, let's assume politics aren't even part of it. I think it would take an enormous market upheaval, a revolt against the inflation numbers we're seeing. Now, that said, the inflation numbers are not good. Inflation really does seem stuck in the 3.5% to 4% range. Real wages, nominal wages are rising a bit faster, which is good for real wages, which is good for the real economy, but doesn't really help you get inflation down, may keep it from going up some more. And so the Fed at some point may face a tough choice. There's no question that the economy has been more resilient to higher interest rates than anybody probably would have predicted. And the Fed at some point is going to have to deal with that.
Now, one of the things, invoke Larry one more time, has said on this program more than once, is part of the reason why the economy seems to be more resistant to higher interest rates is because he thinks that neutral rate, which we can't exactly calibrate, is higher than what the Fed thinks it is. Where are you in terms of the longer term, not just what happens this year, but in the longer term? Are we looking at a higher interest rate environment, and yes, a higher inflation environment, where we're not talking about 2%, we're talking 2.5%, we're talking 3%?
Well, I'm going to leave the theory of all this to Larry and Olivia Blanchard and all the real economists to sit there and debate R-star and all this kind of stuff. But look, if you assume inflation is even 2% in the long run, and you assume investors want something like a 2 to 3% term premium for taking the risk of what might happen over a 10-year or 20 or 30-year period, then 4 or 5% interest rate on a risk-free basis is not unreasonable. And so I think we all got a lot spoiled. We're worried about the other side, the secular stagnation side, during the first part of the century. But now we're facing the opposite issue, and I think we have to expect interest rates to stay higher for longer. And that's a shock to the system, especially for first-time home buyers.
A shock to the system, the one that may explain perhaps your tendency to say, let's take a look at credit, because in that world, credit might be a little bit more attractive because there's a higher yield than, for example, stocks that have a higher discount rate. At the same time, as you've said, private credit's really interesting. Is that getting crowded? Because an awful lot of people are talking private credit right now.
It has gotten crowded. Partly, there's always supply and demand, and yes, it has definitely gotten more crowded. I think when we talked about it last time was the sort of the golden moment where you had high base rates and you had high spreads, and we were able to put money to work at 10% on a floating rate basis in really secure credits, and that seemed to us to be an exceptional opportunity. Base rates are still exactly the same, but the spreads have narrowed 100, 200 basis points. A bit the banks have gotten a little less worried about their own situation. They've come back in the market. And as you said, there have been a slew of private equity funds raised out there to do private credit. And the demand hasn't quite been as strong. Private equity is still pretty slow business at the moment. And so the demand hasn't been quite as strong. And so we haven't certainly reduced our private credit or any of our credit, but it's certainly gotten harder to find new things to do to add.
Steve, tell us about geography. We talked about it in the past. We talked about China at various times. Your views have changed somewhat on that, as, by the way, investors' views have changed as I look at the numbers. What is attractive to you right now geographically?
I think the U.S. is still a pretty extraordinary place. The performance of this economy in the face of everything going on here in the world and so on, none of us, as I said, would likely have predicted this. 4% inflation, 3.5% is not great, but it's not cataclysmic, and hopefully we can get that down. But you have decent consumer spending numbers that just came out this week. You have incredible jobs numbers. As I said, you have real wages still going up a bit. I think the tech community has kind of pulled itself together. AI, which we can debate. It's a little bit like EVs. You can debate, is it going to be big, is it going to be medium, whatever, but it's going to be something. And the U.S. is clearly the leader in by a wide margin in AI. And so I still feel very optimistic here. China has become a value stock, basically, that you can buy very quality companies at 10 times P's that are still growing reasonably, and that is just very attractive. The political risk is enormous, and it's scary, and I would certainly not want to be at China at the multiples that were there 2 or 3 years ago, and we wouldn't be if they were. I was just in India a few months ago. Definitely, I think they're finally getting it together, but that stock market has had a pretty big run, and so it feels like it's a bit priced to perfection. And Europe, as I've said many times on this show and elsewhere, is really not great for a whole slew of reasons and not getting better. They've just got one challenge after another, and they're not dealing with it terribly well, but they've also got a tough hand to play, and so we've been very, very absent from Europe.
You didn't mention Japan, because we have some people come on the program and say Japan really is an opportunity again, where it wasn't for many, many years. Are you seeing it as a potential opportunity?
I should have mentioned Japan. I was also there in the last 6 or 8 months, and it's a bit like India. It's definitely come back, gotten itself together. For the first time, you've got wages growing, you've got the economy growing. But again, you've got the problem that the stock market does a pretty good job of anticipating this sort of stuff, and so the stock market has had a strong run, and so it makes you a little cautious. The yen has obviously had a big depreciation against the dollar, which in a way could be attractive if you want to bet on the yen or hedge it, I guess. But so we find Japan interesting, but a bit like India, might be a little bit late to the party.